Shall we begin?
Yes, we shall.
Okay.
I think the world is going through a transformation in terms of how the investment is being handled, and we're here to talk about the forecast of gold in 2024. And I would love to know your views on the fact that the correlations that are in work with gold, how do you see them change in the coming year?
2024 is going to be a tough year for the markets and basically for the economies of the world. So many different factors are in play. You have the geopolitical, you have the internal politics, and then you have the central banks trying to maneuver through these tough times that we are going through right now. The year is coming to an end, so 2023 is going to be behind us. And as far as gold is concerned, the way it's hitting historical highs and nominally, not
Really?
total,
Not
not totally, as far as taking into consideration the depreciation of the dollar or the inflation adjusted basis and all these factors. So nominally it's higher, but if you take into these consideration and compare it to the highs of before, gold should be around 3,400, something like that. At this time. So it's going to be a very interesting year coming up, and so many factors will be involved, which it looks like is going to benefit the gold.
Exactly.
We'll have to see, but with the numbers, with the technical and with the fundamentals, but the fundamentals are pointing towards higher gold prices historically. And before the base of gold, everybody was looking at 1,000 many years ago. Now that base is coming to 2,000.
That's right.
Because from the opening of gold this year, which gold opened at 1,826.
Wow.
And that was
seems like a lifetime ago.
Yeah, that was a yearly opening. And it hit a low of 1,811 on October 6th. That was the day of the non-farm payrolls for the month of September. And it bounced from that. That coincided with the 200-week moving average. And the next day, the geopolitical risk took over. That's when the conflict in the Middle East, Hamas and Israel started. And gold flew from there. And a couple of weeks later, not a couple of weeks, but a month and a half later, December 1st, it hit December 4th, it hit the all-time high nominally. And it's staying here. So where is it going to close? It doesn't look like it's going to come and close near the year's opening. So it looks like it's going to be a big year. It is already a good year for gold, and going forward from there, it's going to be a interesting year.
Yeah. So in my opinion, there are different factors usually that can affect the price of gold. And all these factors are now pointing at a higher price for gold. We have the central banks are cutting rates, or they are talking about cutting rates, especially the Federal Reserve. We see that the dollar has hit its high in 2023, and it is expected for the dollar to reduce or the price to depreciate. And then we have the economical outlook, which is somehow negative for a lot of countries, especially China and the Eurozone. And then we have the elections, which usually historically, when we have the years of election, gold performs really well. So all of them, if you put them next to each other, they point at a higher price of gold, which could be a bit scary when everyone thinks that the price of gold can increase, but how much can it increase? Is it going to create a new all-time high? Or before it goes to an all-time high, is it going to see lower prices?
Yeah.
Because that's the rule. If it's going to go to a new high, it has to see a new low.
You actually mentioned very good points about the growth and cutting rates and the election that it's coming up. Which one do you think will be the most affecting to the price of gold rising? Because I know that you share this view of gold being bullish for the coming year. Which one do you think could be actually a lasting factor in raising prices of gold?
As far as the reducing interest rates, Federal Reserve has already announced how much they're going to do. Whether they do that much or whether they do more than that,
Right.
that remains to be seen as far as the incoming data from the news of the
which is 3.75 till 4%. I think this is the amount that they announced for
the
the
dot
cut.
plot. They said 4.6% by the end of 2024, but it's never, that changes with every meeting they have. So that depends on all the economic data coming in. One important thing that I noticed in the futures market of in COMEX, that gold for the December 2020, which we are now, it settled on yesterday on 12/15, December 15, at 2021, and the volume was very low, 251. That's how many contracts was in the volume. But open interest was 488. That means how many contracts are outstanding, whether it's options or contracts. But January 2024, the same on December 15, it closed at 2026. And the volume is a little bit more, 634, and open interest is 3,333. This is effective yesterday. This is at the settlement of yesterday. But February 2024, the closing prices, settlement price is 2,035.70. The volume is 166,565. That's the volume. And open interest is 373,817.
So why do you think this change in volume is happening in this
Well,
market?
that means, in other words, people they're already in that market. So
Expectations.
The expiry is not till the 27th of this month. 27th, the gold futures expire. So that's showing that a lot of money is going into the gold already, without even the front month not being done yet. The front month we're in right now. So these are showing that already there's a lot of interest. To your point that you were saying that it's going to go up, and everything is pointing towards the higher gold prices for 2024 and probably beyond, because the futures go all the way up to 2027, 2029.
Yeah, I think 2,250, a range has been somehow fashioned by the future market from the COMEX. I think the range is from 1,850 till 2,250. So this is the range that we expect for 2024. The prices of gold to go up, the price of gold to go up and down. But to your question, in my opinion, there are different factors that can have an influence that is much bigger on the price of gold. I think geopolitical factors it's very important. Usually, it has an impact, and whenever we see like a pump or a dump and the price of gold, it comes from a shock to the market, something geopolitical. But I don't think it lasts that long. You see, because of the geopolitical factor, we can see a rise in the price of gold that is surprising, that is shocking, but you don't see the prices staying there. So I think other factors have to come in hand, and they have to work together in order to keep the price there. In my opinion, something that can have an everlasting impact on the price of gold is something that can happen to the economic outlook, especially something that is related to China and also to the US.
So you're pointing to growth, basically the lack of positivity in
exactly,
the
because
growth outlook.
it brings out the fear, the panic, and that creates a higher demand for gold. And when the demand is higher, obviously we see the prices higher.
That's interesting. Let's take a look at the elections. And you said it historically moves the prices higher. And what about that? How much does that last?
I think it has been reported for the last, I think, 6 elections. 5 times out of those 6 times, the gold has performed extremely well, especially between the 2016 election and then the 2020 election. I think the price of gold rose about 24%. So I think that could have an effect on the price of gold. And the thing is that I think the structure of the world was very different in the previous elections. Now we have Fed cutting rates. We have the stock market extremely positive. We can see the government having a lot of issues, especially related to their budget deficits, and the parties not having the same ideas about the budget deficits, and all of these come into play. But if history repeats itself, I think the election can somehow help the price of gold to rise.
That's an interesting point that you said about the range between 1,850 to 1,000 to 2,150
to 2,250 on COMEX.
Because if the 200-week moving average of gold that it bounced from, now that moving average has gone up, it is 1,836. That's
probably because of the ATH that we just witnessed in the market.
Yeah, because that 200-week moving average, that was back in October 6th when the non-farm payroll came. That's where gold bounced from, and that was over 2 months ago. So those moving averages move up because gold has gone up and stayed up. So if gold comes to that 200 moving average, then it's gonna fill that gap, technically fill that gap, and then maybe they'll buy from there, or maybe they'll in the future it'll come. So technically you have to look at it and fundamentally or politically, what's going to happen, that they're going to try to bring gold down to buy at lower levels. Maybe a lot of people don't, they don't want to buy it at these levels. The big players, central
especially
banks.
the central banks,
yeah.
yes.
This is what I was just gonna mention. We were talking about the sentiment in the market and what could move according to the factors that might lead the prices higher. But the other side of it is actually the central banks and the ones that are actually moving the prices. So if you wanna get back to that, I wanna mention the geopolitical factor that you just said. I agree with you that they come out of nowhere, they have a huge impact, and they leave. But meanwhile, they change some fundamental behaviors in the market buyers. For example, the last time with the February 2022, I guess, when the invasion of Ukraine happened, from that point on, when all the reserves of Russia was actually banned by the United States Central Bank, and they actually kind of lost their support and their friendship out to the open. And since that time, the risk of the FX reserves in the USA, I think it kind of scared the other central banks. So as the data shows, I could actually put the link for you to just check the charts. Even in the first 3 quarters of 2023, we had more asset purchases for gold by the central banks. And this is kind of changing the behavior of saving money and not acting risky from them. And this could mean that the demand that we're seeing for gold, even though so many people are the seller of the gold right now, I'm talking about retail traders.
Yeah.
With everything that we've experienced from the Fed this year, it does not make sense to see gold rising like this, right? So it could not be driven from that. It could not be from the dollar that we're seeing these high prices of gold. The small demand that is coming from the retail traders are being covered actually to the upside by the huge demand that we're seeing from the central banks. And this buying in huge chunks could actually be the reason I have a good view for the 2024, because the risks of geopolitics, they're only rising. And this, as you just mentioned, like the geopolitical tensions in the Middle East are very tricky, and no one knows what it could lead to, even by accident, right? So I think this act of central banks buying or selling towards gold is going to be the main factor derivative of the prices of gold, not the retail traders.
I kind of agree with you, because it has been reported by the Bank of America. I think I showed you the chart. Since 2020, since 2022, as you have mentioned, a lot of central banks have been buying gold, and they are on the way to buy more than 1,000 tons of gold by the end of 2023. And what happens is that they want to increase their gold assets, like on their balance sheet. Right now, it's about 20% of their balance sheet, and the others is by currencies or other assets or bonds, most of it the dollar. And they want, if they increase their balance sheets, the gold amount of their balance sheets to 40%, then that is going to be a factor that could pump the price of gold to about 3,000 for an ounce. And what happens is that if the central banks are buying at that pace and for that demand, first, I think the price has to come down. So they won't buy at the higher.
So worth their while.
Exactly. So the price has to come a little bit down for them to start buying again. So the demand increases.
It's a good point you made as far as the central banks are concerned, because starting in January, 6 countries that have agreed to join the BRICS, they will come into become regular members. So the currency they're talking about, the BRICS having their own currency, the backing of it is gold. So when that's going to happen, nobody knows. But they're talking about, they're already in the works as far as coming up with that currency. Yeah. So what's the shape or structure of it? Nobody knows. But they already announced that backing of it is going to be the gold reserves of that. So that's another point that you made.
Yeah, they want to have like less dependence on the dollar, so they want to de-dollarize their asset, their balance sheet, and I think gold is the best form of money in
for their currency.
Yeah. I think China is one of the countries that it fits the criteria that we just talked about. I read that only 3% of reserves of Republic of China is under asset of gold. This number for Russia is 20%. So meaning if these countries are being aligned and they're trying to put similar goals for each other, we should see the Bank of China trying to raise their currencies in gold.
Yeah.
And one other point you mentioned as far as the geopolitical risk, if this conflict in the Middle East expands and goes to other countries, which can happen at any time, which nobody wants that. None of the countries involved want that. That can have a major effect.
Yeah.
But as she has mentioned, that might be short-lived, but it will give another base to the price of gold. So. Right. That will be another factor that's helping gold.
Yeah, it could create like a guideline for the price, how far it can go and how far it should correct itself so that it would go up again.
Totally.
So shall we talk about, let's take a look at the technical version of the price of gold. So I think every few months, the psychological price level changes for the traders. And what do you think the most important psychological price levels are going to be? Do you see different numbers?
I think 2000 was a psychological level, which broke a few times. Before, they always sold it. It was always 2000. But now it's broken and it's staying up there. So I think, to me, as far as looking at it technically, probably I would say 2,500 would be the next psychological level.
How do we get these levels? How do people decide? Is it in the air? How do you decide which number is more important for us?
Yeah, maybe 2,300, but it has to be a round number that they shoot for,
So we're zeros.
Yeah.
Yeah.
So I think that's 2,500 to me will be the next logical level for psychological level. And then after that 3,000, you know, it's sort of
right.
in that way. So
Yeah.
it's not going to be a straight up or down, but may hit and come back. It may hit and come back, and maybe not in 2024. But with the risks that's involved in the market right now, economically, politically, and geopolitically, and fundamentally, it looks like we might be able to more than what they're saying with these futures. These futures are predicting as it closed yesterday, as it settled yesterday. So that's gonna, you know, in the future, next Friday, when the market closes again, the front month, which is this month, December 2023, the expiry will happen. So we're gonna get new closings.
Right.
It's gonna change how much volume is there, how much open interests are there. So that's gonna be another thing to watch out for, to see how much that changes, to comparison from this week to that week.
It was very interesting for me when you mentioned that the $2,000, like the level has been broken in the market. I would like to know, when do we know we're done with this surface? Because now it looks like once the rate cuts start, or like the talks about them become more visible in the market and more tangible, I think the 2,000 is gonna act like a support rather than a resistance. Because like we just broke above it. And we have done it before, but you know, it came down, and it takes a time. It takes a while.
Yeah.
Right? It takes time to like actually be absorbing the markets that we're done with this level. When do you think we're going to be able to see this 2,000 act as a support, not a resistance anymore?
I think, as you mentioned, gold is staying up above 2,000. Not long ago, or maybe a long time ago, like when gold broke 1,000, I think it was around 2008 or 2000, when it broke 1,000 and it came back down again a little bit, and then they bought it and it went up to 1,980, and then it fell from there. It came close to 1,000 but never broke it again.
Yeah.
It you know, after that it stayed above it, and then 1,300, and eventually when it hit 1,500, it came up eventually to where we are today. Not as harsh, not as fast as it did back then, but it did the same thing here as far as going up above 2,000. Because as you go one level higher, it becomes harder to break until that level, that psychological level, becomes a good base.
Yeah.
So if all things being the same as it is now, and looks like gold is going to go higher, it's going to have to come to some lows for buyers, to big buyers to get
Like
in.
central
Not retail
banks.
buyers, but the big buyers to get
What
in.
could cause that? What could cause the price to drop dramatically for a big buyer to be able to like buy it and buy with satisfaction, let's say?
If it's okay, I want
Sure.
to like include my own opinion. It's something that we have witnessed recently. The Fed rate cuts initially helped the price of gold to go up, but it created a sentiment of being risk on. So people were like really into buying stocks because it has higher risks but higher return.
Right.
But the gold didn't move much after that initial shock and reaction, in my opinion, which is, I think, it might not act really big, but if the sentiment becomes too positive, so people start like going to stocks more, because this rally of the stocks can continue until the first month of January, for example. And if that happens, I think it can create an optimism for people to go for stocks because it has higher return. So the gold might not perform as well because the demand will decrease, and that could create a price level for the central banks to start buying, for the big buyers to start buying, and then for the gold to go up, and then it could coincide with the fear and the recessionary alarms for China and for the whole global economics, and that could make the price of the gold to stay at those high
So
levels.
you're telling me for the price of gold to drop dramatically, we need an optimism, a huge optimism in the market. Could that be caused by like a disappearance of a geopolitical tension?
Yeah.
Do you think that could drive one of these, like the prices low?
Yes. It can not disappearance, but easing of it. If some kind of a peace plan is there. But to your point, before, $20 up and down in the gold market was a lot. Now 50, 100, not 100, but $50, $40, $50 is nothing now. So for the gold to come down into buying levels, which is 1,850 or whatever, fill the gap and as technically is concerned and all of that, that's going to be nothing. May happen in one day.
Yeah.
And whatever happens, the Fed, for example, the Federal Reserve, the Fed comes and says we're not going to cut rates till the third quarter, or we're thinking about it. If the data is coming good, the market becomes convinced that they're not going to cut the rates that soon. That might.
Can they do that? Can they go back on what they said?
No, they can do anything because they'll change a dot plot every meeting they have.
True.
There's no meeting in January. The January, February is one meeting. The Fed only meets eight times a year. And from the other side, from the European side, the European Central Bank said they're not ready to cut rates. The Bank of England, they're both worried still about inflation sticking. So altogether, if the Fed comes and says that, and a little bit of the data starts coming better, so people are going to start thinking that that gold is not a viable place to buy here.
Right. The next meeting of the Fed is going to be on January 31st. Are we expecting a dot plot then?
Yeah.
No, it should be about 3 months. Would it be 3 months? No.
No, it's
if it's 8 times a year, I think
it's
it would
8
be
times.
like,
Yeah, it's January,
so they
February
should
is one
leave the
meeting.
next one with a break, and then they would project their
January, February
forecast
is one
again.
meeting, and then March is one meeting. April there's no meeting. Then May, June.
Yeah.
So if their dot plot right now is saying that for next year is going to be 4.6%. So that can change between now and the next meeting, which is almost 6 weeks from now.
Yeah, so they have this excuse of working based on data, so they have left this door open for themselves.
Would it be an excuse actually? Because I think it has a negative vibe to it. Because if the data are showing, like lack of participation or like a less heavy, labor market, as we're basing everything that we know on the United States and all the scenarios for the soft landing on the strong labor market, right? So if one of those tell us something different about how the economy is behaving right now, I think it would be their right, and as they should, like cut back on people's expectation on what's happening with the overall health of the economy.
Yeah, exactly. So I think with the 3 cases of different types of landing, soft landing, hard landing, and no landing, the performance of gold is going to be very different. So if the scenario of soft landing actually works, I do not think the gold is going to perform like stellar. It's going to be flat somehow, but with the potential of the upside. If there's a hard landing, which creates an alarm for a recession, then that could create like a huge surge in the price of gold, a huge demand in the price for the gold itself. And also, if there is no landing, which the scenario, I think the probability is like very low, especially with the way that the world is like working and all these economies are like somehow interrelated. If something happens to the economy of China, and then there's a lag, or then we could expect, for example, for the price of gold to stay flat, but with the downside pressure. So I think the hard landing or the soft landing, these two are the most probable outcome. Either the decision of the Fed is gonna work beautifully and everything performs really well, they just tick all their goals.
Right.
So the price of gold can have like an upside. Maybe it sees the all-time high that it did, like 2,140, then it comes down. But if it's hard landing, then we could expect all these new highs.
So in terms of landing, I think what we said, we just talked about prices of gold coming down so the big buyers could, do their moves.
Yeah.
The hard landing scenario is not helping that scenario.
Yeah.
So if you want to see the prices moderated and at a buying level, we should be able to either see some kind of soft landing or like another factor in the market.
Yeah, exactly.
But what you were saying, they can bring the price of gold down. A lot of people have buys on gold, so if they decide to take profits on them, price of gold will come down so they can buy it lower. They can bring it down real fast to the levels that are appealing now.
Who are they and how would they do that?
Institutions, central bank, institutional buyers that are in the gold. Because retailers aren't. Retailers are a big part of the market, but not all retailers think the same because they're not interconnected. They're not related. I have a buy and somebody else has a buy, and I may want to sell. He may not want to sell. But institutions, institutions, central banks, for the purpose of buying again, they'll take profits and all that. So if there's some profit taking expiry for this month, for the front month in the futures is 27th of December, just 2 days after Christmas. So it might happen then. Options may expire and price of gold come down. I'm not saying in that level. We don't know. It might bring the price down, and before the next meeting of the Fed in January, they might make another low and then go from there and buy from there. And then the buying will be much heavier because that's where the big players come in.
Do they take their profits in one target, or do they partially leave their positions open? Like, let's say you have invested on gold on 180 and 1890. Do you aim for like 2000, or do you leave out some of your position at 1900, or what do you do?
Well, the ones who have the big positions, I think the way the market is. They do it with options, so their options expires automatically. Instead of settling, they settle with the cash.
Right.
They don't settle with the delivery. So when they do that, big players, how much they bought and all of that will show, because the end of the year is coming and all companies. I'm not talking banks. All companies, hedge funds, ETFs, and all investment institutions. They have to show. They have to close their books. They have to show their, their portfolios, how it was made. So they want to have a balanced portfolio as far as that is concerned. Start the new year, with a new portfolio. Whatever
happens in 2023 stays in there.
Yeah, because it matters with them as far as taxes and all them are concerned. So that they might want to do that, and so because they know they can come and buy it lower, as far as gold is concerned. And as she was saying, we have 7 weeks in a row, the stocks are going up. They just yesterday closed. S&P was flat, but Dow Jones has gone up seven weeks in a row.
Of days.
That's a pretty
Nasdaq
impressive.
saw its all-time high again.
Yeah.
Oh, did it? I only knew
Yeah.
about Dow Jones.
Yeah, it's an impressive high. The S&P hasn't hit its high yet, but it's very close. It came, I think, within 30 or 40 pips, 35 pips before that. 2000. What was the name? The high of S&P was 2,796.
It's not here?
Yeah.
How do you know? How do you know where it is?
I think it was 2,700. Sorry, not 2,000. 4,700 something.
Nasdaq, right?
S&P.
S&P. Okay. It's really interesting that you're mentioning that, because I only today read that S&P 500 and gold are losing correlation at 41%. So what does that tell us? What does that mean while we're seeing the higher highs of the S&P? I mean, we are not still seeing it, but we're expecting it because of this boom that is happening and the very bullish trend that we're having on the stocks. What does that tell us about the coming relation of these two assets for the 2024?
I think sorry, before I think the correlation is that maybe in the past, S&P has outperformed gold because
It actually has,
they
yes.
follow it. But maybe that's becoming, maybe that's about to change or becoming very close with each other because of all the risks that are involved in the market, namely geopolitical and the politics and the recession fears and all of that coming. Maybe that's the year 2000, the era of 2000 to 2030. Maybe that's the era of gold, which we're entering into almost the second half of it. 2024 to 2030 is going to be a very maybe bullish scenario for the price of gold, and because it hasn't historically, it's getting closer to the return of S&P 500.
I think they're so they are negatively correlated historically. So I think this year, because of the performance of the dollar and the bond yields, somehow their correlation got disrupted. But it's going to come into play the next year because we are seeing signs of a scenario for the gold to go higher, and when the stocks are this high, they're bound to come down. So we could see the relationship get negative again, and it comes into play. But something I wanted to mention, if you don't have to.
No, please do.
Yeah. Something I wanted to mention is the trajectory of the global recession. We talked about the recession, the fear of the recession in the US.
Yeah, we did.
Yeah, but that might not come until the end of 2024. And from the beginning of 2024 till the end of 2024, a lot of things might happen. But something that is very concerning, I think, for a lot of investors, a lot of traders, and a lot of big players is the economic outlook that they have for China. So it has been reported that any time that we could see some months of deflation in China when the CPI is negative, it has been reported for 2 months, I think. Somehow the alarm for a global recession is rang, and people fear that this time, if we see 1 or 2 more months of deflation periods in China, we could see the actual signs of global recession in especially big partners of China. How do you think that is going to impact the price of gold? And do you think that's an actual concern that we have to take a look at?
Oh, definitely. I think growth is one of the pillars of, how the price of gold is actually being played out. But I read something about this real estate problem that we are facing in China, and all the investment that used to be there before now is going towards gold because of the negative sentiment that is happening between the investors in China, and the on and off relationship between USA and China. So I think that this is in the air for the Chinese investors to move their capitals towards gold. And as much as the growth concern is involved, I think it's not only China. We are seeing negative signs from there, but we're also seeing it from Europe. And this, only China on its own could not affect the whole market. But if we start receiving this technical recession signs from the Europe, as we are actually from France and from Germany, we're seeing the production being very low, and we're still seeing a hawkish ECB. I think if nothing changes and if we continue with this, it will come to play eventually, but I do not think growth is actually a very dangerous factor for the price of gold, since we're seeing the less good data and news that we get from China, the more we see the protection of the government, the Chinese government, to the household, to the businesses. So it does not simply mean recession. It means that it needs more focus. The growth part needs more, support from the government, but it does not point to a recession very easily.
The data is not coming good for China as far as their growth is concerned, and deflation is a problem, and they need more stimulus. The government has been spending, but they need more stimulus to get the economy going and everything. But there is that fear in China. As one of the BlackRock CEO was saying that Chinese people are saving more money now than they were before the pandemic.
That's fear, all right.
Yeah. When you start saving money rather than spending or investing, that's fear. So that plays out more in favor of gold. And Chinese are the biggest buyers and biggest users of gold.
Yeah, exactly. And the thing about China is that if it's negative or if it's positive, it can have an effect on the price of gold. Imagine when their good economic data comes out for China because of the relationship that the Chinese yuan has with metals, precious metals. They perform really well,
That's
like
right.
copper, like silver and gold. And when the economic outlook is negative for China because of the fear, the gold and also the dollar.
So it's going to hurt us anyway.
Anyway, so we have to, I think it's something that we have to pay really close attention to is how China is going to get out of this deflation, or whether the negative outlook is going to spread throughout other economies, something that has to be taken into consideration.
You mentioned BRICS earlier in this session, and I think the coming years could and the developments that we see in newly made relations between the countries could actually help with that growth outlook of China that is being very negatively seen in the markets right now. I mean, the African countries, the Middle Eastern countries, they have a lot of potential. They have a lot of potential for businesses, for, exports and imports. They're not being fully used. Their capacities are like undermined for so many reasons. But now there is a new window for a country that needs a partner for trade, in terms of import and export. And the other, like China, who was like, eager to like find new friends in the world and like, start businesses on their own terms, without a fight. Although I have seen very friendly conversations being like, mentioned between Janet Yellen and like, all the dinner parties that she goes with the Chinese, and they have said that for the sake of our people and for the sake of the world, we should keep our relationship close. But it does not look like it's working, and it will only get worse from here. So new partners for China, I think it's a very hopeful thing to see these days.
Yeah, definitely. A lot of these countries in the BRICS, the new countries coming in, some of them and some of the African countries, they want to go around the dollar by doing business. They don't like the SWIFT system. So that's why they're trying to get this new currency going. But there's some problems with that because there's problems between China and India, and they're both in the BRICS. So they need to work that out. There's conflicts between them. As you mentioned, there's conflicts, all kinds of conflicts between U.S. and China, who they're trying to mend. It is an election year in U.S., so they're going to try everything. The party that's in power right now, the Democrats, they're going to try
that's why
everything.
We're seeing that.
Yeah, they're trying to take care of that as best as possible, so be feasible for the states as far as for China, not to be so aggressive or to calm down the tensions, because they need each other. Even though
we need them, we need them to be good.
They need each other to for the world economy to be kind of balanced or kind of calm. But at the same time, they got that competition between them. Some at one time they're talking about years down the road how long and all of that, China overtaking the United States as far as the number one economy. But they need to work together as far as calming the conflicts down, as far as politics and as far as the economy. So that's another interesting thing, and it's going to work in favor of gold again in the coming year or years, or however long they do that. But good start of it is the new BRICS that's going to form in January. So the new countries coming in. So how they're going to structure that's going to be interesting.
Something else that I figured out after looking at the projections of a lot of research institutes like JP Morgan and UBS, they all have like this, they show us their forecasts. And what they showed us recently is that the new median price for gold is going to be different in the coming year. For example, for us right now, the range between 1980 to 2020 is something that is normal. If we just cut the levels that it comes down and it goes up, it's not very normal for the prices to go up or down. But what they expect in the coming year is for the price between 2,100 to 2,200 for it to be the new median. And I think that's possible if all of these factors that we've talked about come together and they push the price of gold to go higher. So maybe what we say about the future of the price of gold is for it to create a new range, a place where we expect that it's not going to touch. It's not going to come to 1880 anymore. So it's going to stay there, and then it's going to go up and up again.
That's interesting.
Yeah,
it is. So what do you guys think about this behavior that we're seeing from gold being very popular in the markets as an investment, as a, like it used to be a hedge against inflation, but not so much right now? What do you think is adding to the value of this precious metal these days?
One of the main things that happened in the past, in the last few years, is the ETF golds. In the gold market, the ETF, a lot of people follow that, and that's becoming much more popular.
Well, what happened that we're seeing gold ETF these days,
because
like more and more?
Because it becomes so much popular that people are, instead of buying gold, they're going with they're buying the ETF, exchange traded fund, and that's going to even get more popular. It's going to become more people coming into it.
And it's actually making it easier for gold to become an investment for
rather
the
than
investors.
buying the gold itself, you go in and buy it's got different restriction for it, different rules and all of that, rather than buying the gold for it, the gold itself or the future. But they're all interrelated, but it's become such an important asset that they've started the exchange traded fund for it.
I'm sorry, but I'm seeing like the gold performance, and from what I see from the past 5 years, gold has actually outperformed most of the broad-based portfolio. So it goes stocks, like the interest rates, equities, and then gold. So it's like this outperforming of gold is actually becoming more and more every day.
Yes, and that's why they have the ETFs for it. One couple of points that it's not related directly to gold, but some of the that's in the market, some of the things that's going to affect gold, some of the predictions that some of these big banks have made. I think it was Goldman Sachs. They're talking about DXY, dollar index, going to 97 in 2024.
Wow. How come?
So because of the dollar getting weaker, so it might be at the beginning if the Fed starts cutting sooner, or euro going up, gold going up, and then coming back down to the levels that we're seeing now. So they're predicting that. So that's going to make a difference. But of course, these are all predictions that they're doing. But these are the big players in the bank. And another thing is some of the other in Europe, even some of the European banks and some of the European the government, European Council, they're talking about euro hitting parity.
Yeah, with the dollar.
Yeah, so if euro hits parity and DXY goes to 97, so we're talking about two different, we're talking about gold going way up. Because when dollar gets weak, other currencies get stronger, like euro and British pound and all of them, it becomes cheaper for them to buy gold.
Exactly.
So that's a give and take on that. So what do you think about this scenario playing out? One of them or both of them? Or?
I don't think euro is gonna act that well. I know that it's showing some signals of maybe coming back in terms of the currency, exchange rate, but I do not see the euro staying there for a long time. And
But if it hits parity, it decreases. The value decreases
but how long?
because
how much,
one
though?
euro becomes $1.
But how long would that be continuing? That's what I'm saying. I do not think like based on what I'm seeing from the economy, like the data that also the ECB is acting upon and like making decisions. I do not see euro staying at the parity levels for a long time. So I do not think that it would be a good maybe it wouldn't be safe to like count on it a lot. But maybe I need to read more about it.
It's a good barometer, but it's not. Nobody's saying it's going to happen, but they're looking at it. They're talking about it. When you talk about it and you think about it, and coming from the politicians and also from the bankers and all of that, they see something there. They're looking at
Awakens
it.
something.
Yeah. And as you mentioned earlier, or I think you mentioned it, that Europe is already looking at some kind of a recession. They're already in, like Germany, and so they don't look at things are going to get better anytime soon, but they're more worried about inflation right now, because even though their inflation numbers came down, but they didn't want to commit themselves to following the Fed and all of that. Maybe they'll follow it in the next meeting, but they didn't want to say that, because it'll come to the market that they're all, this is all arranged, that they're all following each other, which eventually happens, but that they don't want to come at the same time.
It's better
The
if it's
market
not out
move,
there.
and they don't want to come back the next day and make the market move the other way, and vice versa. So that's another thing to look out in 2024.
Something else that I think is going to create a lot of demand for the gold in the next year is that we saw great performance of the stocks, as we mentioned. And I think right now a lot of people believe that the prices are going to come down. So they want to insulate their portfolios with something that is going to be safer and something that's going to make them save their money instead of like losing money. As we can see, if we just take a look at the things that are happening in America, we see that the CPI is still at 4%. We see that the US, actually, the government is spending about 20%. The core CPI, yes. And the government is spending about 20% of its GDP. We see that the labor is having strikes all over from different sectors. We see the supply and the demand disrupting in America. So I think for a lot of American investors, and also for a lot of people who somehow their trade or their investment is related to the US market, somehow insulating their portfolio with the gold, because we have a fear that the stocks is not going to perform, the stocks are not going to perform as well. I think that is going to create a situation for more higher demand for gold suits to somehow make their portfolio stronger.
That's a good point there. Normally in the stock market, especially in the U.S. and all that, a lot of these economists, a lot of these CEOs of these hedge funds and investment things, some of them, they don't like owning gold that much in the past, because gold doesn't have any return, and you have to pay it to keep it for you. But those same people, those same players are shifting now. They're believing that they must have some gold in their portfolio. In the past, they had some, but it was very small amount. But now it's becoming more and more, because of all these risks that are involved, especially 2024. I read something from the CME Group's senior economist, and he took a historical comparison between gold and S&P 500 since 1928. S&P 500 has returned 5.9%. Gold has returned 4.9%. It's very close. That's the average return. But gold outperforms S&P 500 during fiscal and monetary expansions, when government starts spending stimulus and all of that, which the United States has been doing. The US and Europe has been doing, mainly because of the corona, COVID, and now that's finished. The economy has gone into recessions and all that, fears of recession. and monetary expansion, to printing money, credit, giving loans, and all of that. And when there's geopolitical risk, and there's conflict, and there's uncertainty, S&P 500 outperforms, gold outperforms S&P 500. This is based on CME's senior economist. And so this happening in 2023 and going forward, so the year 2020 is up, could be the year of gold as far as outperforming S&P or some other classes, some other asset classes.
So do you think that's actually possible to see gold with more returns than the S&P? And we just talked about how it has been affected by the geopolitical risks that we have, which we do not see. It's like a little of them, where there are so many risks in the different parts of the world happening and evolving actually every day. And we have seen that the like all-time highs and lows in gold has always been affected by the amount of policy changes that we see from the United States. I mean, like the rate cuts and the starting of like a vicious, cycle of, interest rates. I think this point that this year that we're gonna like face, it comes with a little bit of, relief from the central banks, even like their balance sheet, normalizing their balance sheet and neutralizing it. So do you think this year could be the year that we see gold outperform S&P 500?
Yeah, definitely could be. Definitely could be. It depends. The central banks make the decision, they make the policies and all of that. They're the catalysts, they're the drivers behind it. So if there's geopolitical risk and there's politics, U.S. politics involved, which is going to be very messy in 2024, central banks, even though they're not supposed to be political, the decisions they make, they could be the catalyst, but because of those other risks that are involved. Just like it was the other night, the central bank, the Fed meeting, right after that, everything, just with couple of words, couple of sentences taken out. They didn't say longer.
Higher for longer.
Higher for longer. They wasn't again, and they came in with the dot plot that before they were saying they were going to cut rate, but it was already in there that something was going to happen.
Yeah.
With the wording, just a couple of words, they changed all that, and now the market has realized that hey, they're not going to go and cut rate tomorrow.
Do they though? Do they realize that?
Yeah, they've come and said it. The other Fed chairs, the other
Williams, Mr. Williams.
Yeah, he said it, and a couple of other ones are going to speak, going to say it. They're going to try to calm the market down. So the market already is pricing in some cuts. So the movement has already happened. Now, what's going to be the next catalyst for the next movement? Probably going to be some of these data coming in and the central bank's decision and during the next meeting between now and then, and also you're closing books and by the end of the year. The end of the year is coming, so they need to close the books, and that's very important for tax purposes, to show the portfolios the investors had, whether it's a hedge fund or investment fund or investment bank, and smaller ones, big ones, all of them. So after that, they're gonna start that fresh. So that might be the time for some volatility there. End of this year, going into next year.
So in regards to what you were mentioning about the Fed cutting rates, so that's not the only way that the Fed is trying to somehow reduce the money supply just by raising the rates. It's about the QT as well, what they're doing to the M2. I mean, for example, physical cash, the savings accounts, and the deposits. So they have been shrinking the money supply at a very high speed by about 4% every time. And 4 times in the history, the amount of money supply shrinkage has been more than 2%. in 1989, 1927, and 1920. All of them led to a great recession and also a depression. So something that a lot of people are saying is that although the money supply, the contraction, I mean the QT with this speed, has a lag between 12 to 24 months, but in about a year and a half, it is going to create something like a recession or a Great Depression in America, something that can create a huge demand for gold. And a conspiracy theory is that for the price of, if this happens, the price of gold can reach about $15,000. Do you think that's ever possible?
For $1 billion?
Yeah, for an ounce.
For an ounce.
Because, yeah, it's something else as well, because you mentioned when the time changes, the somehow the volatility or the changes in the price of gold gets different. For example, in the past, $20 change was a lot. Now, $100 is something that can happen in a span of 2 or 3 days. If something like a huge depression or a recession happens in America, do you think that is going to create a situation for the price of gold to go way up or way down?
I actually think that I'm so sorry. Go ahead.
Go ahead.
There's a way to check it, because we can check the charts on the day, on the years that this conspiracy that you're talking about and you're assuming it might happen. We can check them and see how much the price of gold depreciated. So we can, like, it could be around that, but 15,000, I think it's a long shot. Don't you think so?
It's a big price, but that's why it's a conspiracy theory.
Yeah, it's
right?
a conspiracy theory, because for me, it's a very big number for the price of gold to reach that level. It should be something very a kind of panic that creates a sort of big demand for gold. But if something that I've mentioned happens, I mean the contraction in money supply continues by the Federal Reserve, that might create a situation for a recession and for the price of gold to go higher. Maybe not as much as 15,000, but for it to go really high, I think that's possible.
For people to protect their money, because the currency is not going to be worth anything, because behind it is whatever is behind it, the money printing and all that is not viable anymore.
And then you don't know what's what anymore, so you might just go to the safest place that you know, which is gold.
Exactly.
As long as we're on the conspiracy theories, I had one of our the people who are always commenting on our YouTube shows. He texted me. He was like, "What if the Fed, they being the Fed, what if they start like printing a lot of money and they start buying all of the gold that is out there with all of this, all the excess money that they have, with the excess dollar that they have, and they don't spend it, they just reserve it. What happens if we see a huge amount of money printing and then,
Buying from whom?
From the market, from the Fed, if you see a lot, because, okay, we talked about how the countries that are actually being new players in the economy, like China, like, African countries, how Middle Eastern countries, they're actually buying, and it's the demand of their gold is increasing because of, their side. And we're seeing the Fed relieving the pressures for buying, and this is kind of actually evening itself out. What happens if the Western countries also start buying, and, that increase the demand double too, and, they double it by 2. What happens to the price of gold? I think this could see the 15,000s that you're talking about.
Maybe not 15,000, but definitely go up to 3,000 at least next year.
Yeah.
One thing that I said before, when gold settled at 2,089, it was on December 1st. That was on a Friday, and at that time, if historical comparison with the high of gold from before, that gold that was just a number. It should have been 3,452. So if you compare it historically, you have to go by the percentage of what had happened. And if that kind of a percentage goes with the prices we have today, of course it's going to be, gold should be much higher than it is. And this is my own thing, my own idea, my own thought, not just thought, but my own
vision,
mentality.
That gold should be much higher than this. I know read on CNN Business Finance and in other business journals that gold is not the answer, neither is the crypto and all of that. But in this day and age, not one thing is the answer to the economic meltdown or economic downturn, or with these other risks involved. You know, you got the economy, you got the politics, and you got the geopolitics. So, to me, looking at it, I'm not saying everybody should. Nobody is gonna put. They always say don't put all your eggs in one basket, but gold should be much higher than it is now, with all the money printing that's been done before from the COVID pandemic till now. Even though they, like you were saying, they reduced their balance sheets and all the treasuries they were buying, because when they print money, they put more treasuries out and they come and get it, just like companies when they buy back stocks.
Right.
to have the shares company look stronger. So to me, gold should be much higher than it is now.
Even though we just had a very tight cycle of increasing rates from the United States, you still think the price of gold that we're seeing right now, which has been decreasing because of the kind of policies that we're seeing, the hawkish policies that we're seeing from the Fed, you still think the gold should have been higher by this time?
But yeah, and I raised rates, gold went way down. Dollar became strong and gold was down. But this time, gold didn't go down that much. Even when Treasury yield hit almost 5% a couple months ago, right before gold went back up. Even then, gold was 1,800 something. It wasn't going down like before. Before they used to raise rate 2-3 times, everything would go down. Everybody would go. It was harder for people to. They didn't need to hold gold anymore or other assets.
So you think what we're the performance that we're seeing from gold is it's not driven by the Fed policies. If not, what is it moving by?
It is not as much, not as much as before, because it should have gone much more down than it is now, when they kept raising rates. And as soon as they stopped, they announced, they gave the signal that they're gonna pause. And maybe one more rate hike and all that. Gold was still not going down. They even mentioned that they might raise one more time. And it didn't happen, and then gold flew. So it's not like before, even though history repeats itself and we have to look at the back. Yes, we do have to look at the past, but times have changed, the dynamics have changed, other players, other things are in the markets, in the economy. Not even including the geopolitics and the politics and all of that. You bring those factors into it, you're looking at much more backing for gold than it is. So to answer your question, I think that is proven with these tightening cycles that gold didn't go down like it should have.
So I think gold is still the best form of money, and it has proven to be by its value, and it has decreased. Whenever it goes down, it comes up again. So I think the function of the gold has become different, as you have also mentioned, not as much as a hedge against inflation, but mostly something that has demand out of fear of recession, fear of geopolitics. And I think that could create a situation in 2023 for the gold to perform very well. 2024, yeah.
I think you just made the point that I was trying to talk about the whole show, and even you made it clear in my own head beautifully. So if the gold prices are not being affected by the interest rate as much as they should, and as much as they have proven to be up, in the previous cycles of interest rates, could we say that the demand, the increasing demand from this newly mentioned countries like China could be the main driven of this prices, higher prices?
Yeah, definitely, because in the past, when they were raising rates in previous administrations or previous time, China wasn't that that big of a player. China's economy wasn't as free as it is now. It's still restricted to a certain degree, but much, much more freer than, let's say, 20 years ago. So now China is in the BRICS want to have their own currency backed by gold and all of that. So all these dynamics are adding to, if they keep raising rates and gold should come down a lot, it's not coming down. It didn't come down that much. It still went and hit highs when they were raising rates.
And it's not only China. I mean, like after the invasion of Ukraine and the confiscation of, the Russian government's, assets by the United States, whatever country that has some kind of relation to the U.S. is actually afraid that this, if should there be a day that we, don't see eye to eye, as the whole government, the same thing will happen to us. But like gold, when you have it, you have it. So you're sure of it. Yeah, and also this higher demand from these countries, meeting the lowest levels of demand from U.S. is the reason I think that we're not seeing price of gold higher. Once the U.S. starts also buying, I think we're gonna see the price of gold in prices that you expect.
Yeah, and but like you said, Russia is part of BRICS too.
Yeah,
exactly.
So the BRICS countries
BRICS, yeah.
and also the Western countries, the Europe and the US, higher demand for gold, so it's gonna put the prices higher.
Merry Christmas to gold.
Exactly. So I think we talked about everything as a trader's point of view. If they want to trade gold in the next year and if they want to invest in gold, we know that other than the technical, psychological price levels, we have to take a look at the economic outlook, the recession risks in the US and in China. We have to pay attention to the demand from central banks and also to the fundamental factors that we always look at, that is related to the dollar and the performance of the dollar, because still, as much as we say that the relationship between the dollar and the gold has somehow, it's not as strong, the negative correlation, but it is still a big driver. So we have to take into consideration the fundamentals that can affect the price of gold.
And of course the growth outlook that is becoming more and more gloomy every day. But I hope there's going to be a pivot point to that with the more support from the countries that need it, like China, or more demand or more purchasing power from the the consumers in other countries like the Eurozone or the US.
Yeah, as soon as some kind of a level, someone a support level comes, maybe things will ease. But to your point that you were saying, 10-year yield yesterday was at 3.915. That's a little below the inflation, the core inflation, 4%. So we're looking at the exact same, almost the same to inflation and the 10-year treasury yield. So that's that's another driver that's there for, even if treasury yields are coming down. Hit at one time 5% a couple months ago, and now it's below 4%. And that's more in line what the analysts of the hedge funds and investment banks and investment companies are thinking, between 3.25 and 4.25. That's what they were thinking for the rest of the year, and the year is almost over. So how it starts the new year and all of that, that's going to be the main point of how gold is going to perform.
The stepping stone, and then it goes on from that.
You actually gave me an idea about the inflation. We didn't actually get to talk about the inflation of the U.S. What if inflation comes back? Because we are already pricing lower rates, and the markets. I don't know if it was the market who signaled it to Fed, or is it the Fed that is market signaling the market. But what if we get inflation back? Because this has happened before. In the crisis of 2008, we saw the labor market performing weaker than we are seeing right now. But also we saw the inflation coming back and reappearing in the economy. What happens to gold if we still see inflationary pressures?
I think we can expect, if the inflationary pressures are really damaging the economy, and it's the purchasing powers of the consumers, especially I think we're talking about the US. If that happens, I think the Fed has no choice but to raise the interest rates. But as I've mentioned, they are right now shrinking their balance sheets as well. So they're doing the QT in order to somehow control the inflation. And also they always mention that their rates, the higher rates always have somehow a lag in the economy.
Right.
So that can also have an effect. And they're not cutting rates right now. So if they're cutting from May or March. And I think by then we could see lower inflation rates as well. But if the price of oil, for example, increases and it stays at a higher level, I think we can see inflationary pressures. And that could not be a good scenario for the gold.
Also, stagflation is not good. Stagnant economy, no growth, and inflation. It's not a good scenario because what are you going to do? Raise rates or lower? You can't lower rates because inflation is being sticky and all of that. So that's not a good scenario as far as an economy or a government or a country wants to be in. So if it doesn't come stagflation and the economy is still doing good, so they can still raise rates, and they've said that with income and data. But the dot plots that they did with the Fed, they're looking at it that they're seeing something that it's also the election year, and they're not going to let oil, if they have to release more reserves from the states, if they reserve oil strategic.
As they are.
They have done it. Yeah, they have done it, and it's election year, so they're gonna do, with the government that's in, they're gonna do whatever it takes to try to control inflation and also do a little bit more stimulus, forgiving student loans and these kind of things and all that, making credit easier. But right now with higher rates, banks are hurting, because it's hard to lend. You got less customers. They don't want to be in mortgage rates are high.
They don't even want them there.
Yeah. But because of the inflation, they had no choice to do that. And you don't bring inflation down with one or two rate rises. You bring them down over time. It's not something that you can control it, in a couple of meetings and all of that.
Exactly.
But so they're seeing something in the dot plots, and I think until if things do deteriorate, then that's a
Bad sign.
Yeah, that might, if things do become worse than it is growth-wise, then they're gonna cut earlier. Not worrying about the inflation. If they're not worried about the inflation and things start deteriorating, then they're gonna cut sooner. So that's gonna be another positive for gold.
So
And maybe other currencies too, and when other currencies get strong, dollar gets weaker, other currencies, go up and all of that. So that could be a good scenario. Even other countries start buying gold at cheaper prices if their currency is cheaper.
True. So I think the bulls of the market of gold, they know what to look for now.
Yeah.
And thank you for setting your criteria for the year.
Yeah.
It was very nice.
Thank you.
Gave me like a really good outlook. Now I have a somehow more open mind to see the price of gold and the behavior that we can expect in the following month.
I think we should finish with the sentence that we first started. All the factors are showing and pointing to a heavier pricing gold for the next year.
Yeah, exactly.
Yes. Happy holidays.
Happy holidays
to everybody. And
are we off?
Thank you.
Are we going to be off?
For Christmas?
For Christmas in the market.
Market's closed.
Okay, I think we're still going to be here though.
Okay.
Market's closed. But thank you. A lot of insight. I heard a lot of good points from you and from you. A lot of things that, small intricate things that you had to prepare and all of that. So it was very, very
Thank
good
you for being here.
Opened my mind a little bit.
Thank you for sharing your insights with us.
Thank you.
Okay.